Hi guys, welcome back. Today we're going to be looking at Baba and we're going to be looking at whether this company is a buy. Over the last few months, the stock is down. The stock has been flat year to date, but is down more than 30% from its October highs, where it hit $320. The decline in share price started when the IPO for Ant Group was put on hold due to the Chinese government's intervention with the IPO, and since then the stock is down more than 30%. So today we're going to be looking at whether this company is a buy, and if you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So about Alibaba and their recent news. So in 2020 was an amazing year for Baba. Their cloud services and e-commerce businesses were booming. In 2020, they reported a 35.2% revenue growth and a staggering 70% net income growth in 2020. On April 12th, the stock was up more than 9.3%, and this was the stock's best performance in months after downtrend, and it finally gave investors something to cheer about. So what happened that pushed the stock up more than 10%? The stock was given a $2.75 billion antitrust fine, but it was much lower than what investors were expecting, so they saw it in a positive light, and they believed the company could rebound it very strong, especially since it was only 4% of its 2019 revenue. The company has been under pressure for months as investors were worried about increased regulations and more antitrust measures that were heading its way. The stock was at an all-time high before the involvement of the CCP with the Ant Group's IPO, and since then the stock is down more than 30%. The stock is currently trading like a value stock with amazing growth potential, which we'll cover later, especially with a PE ratio of just 26, and we're going to be looking at the future growth later on. So first, before we read that, we're going to be looking at the regulatory concern. So Alibaba is a massive force in the Chinese e-commerce industry. The US and China have had multiple trade wars over the last few years, and that's due to this there has been many threats about the US delisting Alibaba or China putting increased regulatory scrutiny over Alibaba. But I believe none of this will manifest, as Alibaba is the 8th largest company in the United States, in the United States stock market, with a market cap of more than $660 billion. Although the company, so I don't believe they will delist the company, especially with such a big involvement in the US's economy. The Chinese government has been fining Baba slightly, but it hasn't actually hurt the business anyway. The $2.7 billion fine is between 0.5% and 1% of its market cap and makes barely a dent in their current revenue. The Chinese government needs Alibaba as they try to expand into Asia and slowly become a stronger force in the global economy. So I believe both the US and China need Alibaba, and other than threats, I doubt any of them will be making moves to actually hurt Alibaba's core business. So what is the future growth for Alibaba? Once again, this company is worth around $662 billion, and it's going to generate more than $100 billion in revenue in 2021. Their top line has been growing steadily, more than 40% in the last year, and their cloud business has exponentially increased in the last few years. They also have plans to expand internationally. But currently, the Baba stock is trading incredibly cheap. Although the company is investing billions in growth efforts such as cloud business and logistics, the company has only been trading at a PE ratio of 26, which I believe puts it almost as a value buy, especially with the growth that it shows to us. It currently dominates the e-commerce market in China, especially with a population of more than $1.4 billion, and the middle class that primarily spends in Alibaba is larger than the entirety of the US population, which is why I believe Alibaba controls a massive share of the global e-commerce market. On top of this, it owns many other subsidiaries, two of the most popular e-commerce sites in the country, Tmall and Taobao. Tmall is the third most popular website in the world, and Taobao sits at 8. And then on top of this, you add their core business of e-commerce and their Alibaba website, and this shows how strong of a company this really is. There have been many analyst estimates, and they expect on average a 40% revenue this year, followed by 31% growth estimate in 2022. So especially with a PE ratio of 26, I believe this is an amazing buy for any investor looking for a cheap growth stock. The next thing we're going to be looking at is their financials. Just be aware this is in Chinese yuan, so that's why the numbers will be slightly inflated due to their conversion rate to the US. However, we can look at the trends lines regardless, with the earnings per share increasing very well over the last few years, more specifically from 2017 onwards, where it jumped from 24 all the way to 57 right now. The company doesn't pay dividends, so that's off the table. However, their book value per share has been increasing solidly, but not enough for it to be a value play. Their operating cash flow, cap spending, and free cash flow have all been increasing amazingly. For example, you could look 80,000 Chinese million yuan in 2016, all the way to 210 million in 2020. Free cash flow 60,000 all the way to 164,000. So you can see more money's coming into the company, more money's being invested into the company, more money's being saved for the company, and more money's going out of the company as they try to invest into their expanding businesses. Their net margin is pretty healthy at 25%, although not great for an e-commerce company that is traditionally less capital intensive. It is still very solid. On top of this, their return on equity is slightly lower than what you would prefer, but at 19% is still a very good, solid use of their investors' money. Their interest coverage of 40 is amazing. That means that they can pay off interest on their loans for 40 years. And their debt to equity ratio is very conservative at 0.11. Shows that the company doesn't have too much debt and they can take more risk in the future, looking for better rewards. Their price to earnings ratio is currently only 26, especially looking at the future growth we looked at on the previous slide. We can see that this company is trading at a very cheap price right now. Their price to forward earnings is even lower at 21, and their PEG ratio in 2020 was 0.8 and is currently at 1.36, which is not too much higher, showing that the company is trading at a cheap price but is also growing really, really fast. The last thing we're going to be looking at is the technical analysis. We can see over the last 1.5 year time period, the stock has gone from about $160, hit 320, and then is down all the way at $232 right now. However, over this time, there's been a pretty strong support line that is depicted by the red. Each time it's hitting it, the first time in November of 2019, then March of 2020, January of 2021, and then currently April of 2021. You can see each time it rebounds, it goes up a very good amount and once again rebounds to an uptrend. Here we can see is the latest time, so I believe once again the stock price is going up. Although for the last few months there's been a downtrend, anytime it's rebounded it has gone up, so I wouldn't classify it as a complete downtrend. However, there has been a solid reduction in price since October. On top of this, the stock price is trading below its 200-day simple moving average, and especially for a growth stock, that is one of the best times you can enter, especially with the stock showing promising future growth in the future as well. So just some final words, it's currently trading at a cheap price, making a solid comeback in 2021. Currently, I believe this stock is undervalued and has amazing future growth. However, there is some regulatory risks to keep in mind. Currently, I believe there are only threats, then no country will really go through with it, but you do need to take it in consideration if you do choose to invest. So if you do buy BABA, make sure to do your own due diligence, and thanks for watching. Bye.